Okay, so in this video, I'm going to talk a little bit about the taxation of annuities. Um, so basically, for annuities, the income is going to essentially be taxed, but it's going to be linked to the basis. So the basis is essentially considered to be what was contributed to the annuity. So the basis is typically going to be returned tax-free. There are some sort of caveats to that I'll come back to in a moment. But the basis is typically going to be returned tax-free, and then the additional gains that were accumulated for the annuity would be considered essentially income that hadn't been previously taxed and therefore would be subject to taxation. Now, there are a few other sort of little caveats here. Normally what happens is there's the accumulation phase for the annuity. So yeah, and then ultimately it is annuitized, and so it goes through the annuitization period. So if a person withdraws the gains before annuitization, then all the withdrawals are considered to be coming from the gain and subject to income taxes. And basically what's happening is sort of a last in, first out kind of approach. So the gains were sort of last in to the pot of money, as it were, and therefore they're considered to be the first out if there are withdrawals that occur prior to the annuitization. Also, there is a possibility of a penalty tax for early withdrawals in some contexts, so that needs to be evaluated carefully. Now, if an annuity is purchased with pre-tax dollars, then in that case, all the withdrawals are subject to regular income taxes because essentially then the account is assumed to have essentially no basis because no income taxes have been paid on the money that was contributed previously. And so basically at that point, all of the withdrawals are going to be subject to the regular income taxes. Now, for the accounts that do have a basis, when payments are being received, the payments have to be split into what's considered to be the return of the basis and what's considered to be the gain, because the gain is actually the taxable part. And that's assuming that there is a basis, which means that we're assuming that money was contributed with post-tax dollars. And so the return of the post-tax dollars doesn't require taxes, but the gain portion does. So the payments have to be that the person receives have to be basically split into those two components. Also, for purposes of handling some of these kinds of things and calculating some of this, there is an aggregation rule, which means that all annuities purchased from the same issuer in the same year are viewed as one giant contract. And basically, the point there is to just sort of simplify the situation and try to avoid creating a situation in which somebody could try to somehow kind of adjust how they're counting something for tax purposes, et cetera. There can be some situations in which it might be possible to surrender an annuity with a loss to claim it as a tax deduction. So if there is a loss associated with the annuity, then that might be possible. There are also Section 1035. I believe that refers to the tax code exchanges. This is when it's an annuity for an annuity exchange, and if certain conditions are met, then a Section 1035 exchange of an annuity for an annuity can be performed without triggering taxes. But the conditions have to be met for that to be true. So you have to make sure that everything is very specifically set up and all those conditions are met before anything is done if you want to avoid triggering a taxation event there. Generally, what's going to happen for an annuity, if there's a beneficiary listed, then basically what's going to happen is this is going to have estate tax implications. And so there's a transfer essentially to the beneficiary, but this is still linked to the estate, and so there are still estate tax implications for that. And one of the interesting estate tax implications is that annuities are considered to be IRD assets, which stands for income in respect of a decedent. And so basically, what's happening is for that annuity, because those gains haven't actually been taxed, then basically there's no step up in basis. So I need to do a little sidebar here. step up in basis and what's happening with that. So if a person owns a share of stock, for instance, and they bought it 20 years ago for $10, and now it's gone up to $100, that means there's $90 of gains, unrealized gains associated with that stock. And if the person then dies, normally what happens is it's called a step up in basis. And so basically on the day that person dies, when the stock is worth $100, then what's going to happen is that's going to become the new basis level of $100 for the person who ultimately inherits the stock. So if that person, a beneficiary, inherits the stock, and the stock goes from 100 to 105, they're going to pay taxes on that $5 of gains, not on the $95 of gains from when it was initially purchased at 10 up to 105. So that's the step up in basis. The basis is going to get bumped up to the $100 at the point in time when the original owner died. Now, having said that, the basis is going to give up to 100, but that 100 is going to be used when determining the estate value and whether the estate pays taxes before the things are passed on to the beneficiary. So the beneficiary is going to receive the step up in basis, but the higher value is going to be used when determining whether the estate has to pay taxes at the estate tax level. So now that we've kind of gone through that little discussion, back to the annuities. For the annuity, what you have is these gains that have accumulated. But for the annuity, there's no step up in basis, and so we don't reevaluate the value of the annuity there. And probably part of that is to kind of make these not necessarily as attractive as certain retirement accounts might be and things like that, perhaps. So basically, there's not going to be a step up in basis associated with this. Instead, to the extent that the annuity increases the estate tax liability, it can actually kind of subsequently trigger an income tax deduction. And so it's kind of handled a little bit differently from the step up in basis kind of approach. All right. So generally, if an annuity is passed on to a beneficiary, generally that's going to be considered to be taxable income. And essentially, it sort of starts to make a certain amount of sense because the beneficiary doesn't really have like the basis or things like that built up. So generally, it's just going to flat out be taxable income for the beneficiary. Now, there are some little caveats here. So if one distribution is taken within a year for that beneficiary, so if the original person has died and it's now going to the beneficiary, if the beneficiary takes one distribution within a year, then the rest of the money associated with the annuity can be rolled into another annuity with a longer time horizon and therefore kind of delaying taxes. So that's a possibility there. Now, a spouse may just delay the distributions in every way that the original owner could. So if the original owner dies and it's passed on to a spouse, the spouse can basically delay those distributions in every capacity that the original owner could have for tax purposes. Now, if the beneficiary is not an individual, then the distribution from the annuity must occur within 5 years. And so that's basically the government is sort of requiring that the distribution occur within a certain time frame. And in fact, normally so they can get their taxes in a reasonably timely manner, basically. And if you have non-natural owners, so let's say a company owned an annuity or something like that. So if they had an annuity kind of a situation like that, the non-natural owners would report earnings or accruals as just ordinary income for tax purposes. Okay, hopefully this clarifies a few things and helps a little bit with some of the interesting quirks associated with taxation of annuities. Thank you for watching and have a great day.